So today we are going to finish up IAS 12 and we're going to structure our next line of actions. I greet you all again and I welcome you to Equity Professionals Strategic Business Reporting class. Remember vividly that we started with IAS 12 on income taxes. Today, we're going to continue with that. So, we spent a lot of our time last week trying to understand deferred taxes because when it comes to IAS 12, I told you that the focus of IAS 12 is majorly on company income taxes. And when it comes to company income tax, the one we can visualize, the one we can see is the tax we pay directly to the government. And these taxes is usually computed on taxable profits. But with IAS 12, we are being exposed to the reality that is actually beyond just the tax you pay immediately to the government, that there are other taxes that we need to consider. I started by defining taxable profits. I looked at accounting profits. I look at income tax. And that was where it started because I told you that when it comes to income tax, I said it's an aggregation of your current tax and your deferred tax. The current tax is the one you pay in the current period, and it's usually with respect to your taxable profit. That is, when you have your taxable profits and you apply 30% on that, it gives you your current tax. And I told you that this current tax, yes, you need to make the estimate of that tax for that year, but in order to pay it to the government, you can't pay it that year. You pay it in the next year. And as it is in Nigeria today, we pay through tax Promax. And immediately it's in the first day of the next year, then your tax Promax will be open for you to file your return. You can pay between your year end and 6 months after. You have that window to ensure that you file your return and you pay your estimated tax or provisional tax, as it were. So when you file your returns, the tax authority looks at it. They will immediately send you a desk review report telling you that the amount of tax you pay is not sufficient, and they will tell you why. And I'll also ask you to provide some further information if need be to substantiate some of your expenses, as it were. So you find that you will need to make some adjustments to the taxes you have estimated in the previous year, whereby you would have to have either an underestimation for tax or an overestimation for tax, depending on what you have agreed with the tax authority. So if you estimated 50,000 naira as your tax for 2024, for example, now, in 2025, by the time the tax authority reviews your books, they could say that your tax should be 70,000. So they will ask you to come and pay additional 20,000. If you agree to pay that amount, that 20,000 would represent an underestimation of tax because that 20,000 is a makeup. That 20,000 was an amount you should have expensed in the previous year, but for whatever reason, it skipped you. But now the tax authority have identified it and say pay it. So you underestimated. And I told you that the way it's treated is that you're going to add it to the expense of the current year. I think somebody asked a question that is it not relating to last year? So why are you adjusting it in the current year? And I told the person that it's more of a change in accounting estimates. And according to ISA, changes in accounting estimates are adjusted prospectively going forward. We don't adjust it retrospectively. So we looked at all of that. We solved some questions on that and for current tax. So that wasn't so difficult because everyone understood that very fine. Then we went on to deferred tax. For deferred tax, we identify that these are taxes that are paid or recovered with respect to temporary difference. And it's always in the future period. So deferred tax is with respect to future period, and it is payable or recoverable on the basis of temporary differences. So to understand deferred tax, all we need to understand very well is temporary differences. As soon as we understand that, that means you understand deferred tax. And I told you very clearly that the temporary difference is the difference or the timing difference between the amount recognized in the books, in our books, and the amount captured by the tax authority. The difference between the amount recognized in the books and the amount captured by the tax authority. That is temporary difference. And I told you that the amount we recognize in the books, you will see us referring to that as carrying amount. The amount the tax authority recognizes or captures, you will see us calling that tax base. Whenever there are differences, whenever the tax authority don't capture what we have in our books, there will be temporary difference. And I give you examples. And one of the examples I gave you, I told you provisions. Provisions can result in temporary difference. I think I gave you an example of a client of mine that were doing an audit and they had director's fees in their books, in the books. But when the taxman came, taxman said, we will not capture it, that we will disallow it. I said, why? They said, they said they are not sure that we have paid it. I said, okay, let me confirm for my client. I went to my client, I said, okay, the tax authority said you haven't paid this amount. Can you give me evidence that you paid it? Oh, they said, we have not paid it, we'll pay it next year. I went to the tax authority, I said, okay. They said they will pay it next year. He said, fine. When you pay it, we'll allow it as a deduction. I went to my client, they said when they pay it, they will allow it as a deduction. You see, in that scenario, that director's fees is in the books, is in our account. but the taxman is not going to capture it. It will have no tax consequence for that reason. But taxman will capture it when they eventually pay it. That's temporary difference. So it's in our books, but it wasn't captured by tax authority this year. That's temporary difference. Oh, so gave you example of impairment loss. When you have an impairment loss, it's in your books, of course. But when the taxman sees it and say impairment loss, you say, no, show me the evidence that you lost this thing. I'm saying, no, this is a remeasurement loss. No tax authority will allow remeasurement loss. They will tell you when you sell the asset and you incur that loss and you receive less than the value of the assets, we can see that yes, you have lost amount. Then we'll allow it as a deduction. So they will not definitely allow that impairment loss. So it's in your books, but the tax authority will not capture it. They will capture it later, of course, but that's when you realize it. There's a temporary difference. The difference between what you capture in your books and what the tax authority captured. And the list goes on and on. And I told you very well that there are some difference that is not temporary but permanent. I said we are not looking at that at all because that one does not have deferred tax impact. It doesn't have tax impact generally, anyways. And I gave you examples of that. I said exempt income or item that has no tax consequence. In fact, that's what we are looking at now. Like grant income or donations. You know that when you make donations to unapproved bodies, based on the current tax law, they will disallow it. And they will never allow it. It's not like they will disallow it now and allow it later when you do something. No, it's never allowed. So that means you have it in your books, but it's not captured for tax. There's no difference. We move on. Now that's a permanent difference. No different tax consequence for that. Grant income is exempted income. No deferred tax, no temporary difference because that difference is permanent. See, we explained all of that. And I think it is important for you to note that what we are trying to achieve here is still ensuring that we comply with accrual basis of accounting, accrual concepts. Because if I was in your position as a student, if I was a student, the question I would be asking my lecturer is this, that, okay, Oga, why are we stressing ourselves? The taxman did not capture it, we capture it. Why are we stressing ourselves with that? If he doesn't capture it, he should not capture it. Maybe we will just pay more tax. We have already prepared our book, so why are we disturbing ourselves around all of this? That is what I will be asking my lecturer. And a good lecturer will tell me that, no, that means you're missing out on the core accounting concepts. You see, accounting concept is about ensuring you capture all economic activities, including the taxing part of them. You see, all items in P&L, whether income or expenses, they ultimately have tax consequences. They have tax impacts. And that's what IS 12 is coming here to achieve. They have tax impacts. So if you have an item like the director's fees I explained to you that we put in our books today, but the taxman says that because you have not paid it, he will not allow for deduction now, but he will allow for deduction in the future. Meaning that ordinarily that item has tax consequence, But because of the rules of the tax authority, they said, wait, I will capture it later. You see, we cannot work on cash basis. So we need to accrue for the tax. Even though the tax man will not give it to us, we accrue for it. Accounting is not on cash basis. So if they will not allow it, if they would not effect it for tax, we need to accrue for that tax. And that means deferred tax is actually an accrual for tax. That's all we are doing. But we just had to bring in how to calculate that accrual by saying, okay, the reason why we have to accrue is because of temporary difference. It has to be temporary. It has to be because the taxman did not capture an item that has a tax impact. They did not capture it this year. They want to capture it in another year. So we really have to sort that out. You need to understand that very well. And finally, you see this temporary difference, I explained to you that there are some of it that are taxable. So, and the way you figure that out is looking at the question, looking at the scenario, and understanding that whenever you are going to have to pay more tax in the future, that's a taxable temporary difference, right? And whenever you are going to get a deduction in the future, that's a deductible temporary difference. And I told you that by the time you apply 30% on a deductible temporary difference, it gives you a deferred tax asset. Gives you a deferred tax asset. When you apply 30% on a taxable temporary difference, it gives you deferred tax liabilities, right? And that's everything. That's everything. So today, we're going to solve questions, as many as we can for today. I remember vividly that I gave you 3, 4, and 5 as assignments. And I know that you guys have done it. I know that for sure. So since you have done it, then this should not take our time, because here they said current liabilities include accrued expense with carrying amount of 10,000. That means the carrying amount is how much? It's 10,000. And what's the tax base? Since we're told that the related expense is already included, has already been deducted for tax purposes. So that means what's the tax base? Who can tell me that?
10,000.
10,000 naira. That means the temporary difference is what? What is 0?
So, I mean the temporary difference, it is 0.
Oh, yes. The temporary difference is 0. But I thought you were going to look at this one again and think whether it's confusing, because even me as a lecturer, I will have looked at it twice, because they said the related expense has already been deducted for tax purposes. The examiner was not very specific, because even though accrued expense, they said it has already been deducted for tax purposes. Is it this year or next year? Or last year? When did they deduct it for tax purposes? Did they deduct it this year or last year? If it's this year, then fine. That means they captured it this year. If it's last year, that means they captured it last year. That means the tax base this year will have been 0. But it's just good to be on the safe side, because here is saying they have deducted it. It's already deducted. So it's easy to put the tax base as 10,000. Okay, they have deducted it for for tax purposes. Just similar. I think we did something similar. Where is that one? That we said the related revenue has already been included in taxable profits. And we said that means they have included it as part of our taxable profit. So that's 2,000 naira. Yeah, so it's very similar to this one, that it has been deducted for tax purposes. So it's 10,000. Then also this one also, they have a current liabilities relating to fines and penalties. Current amount is 3,000. We are told that fines and penalties are not deductible for tax purposes. So what's the tax base? That will be 0, because they are never deductible for tax purposes. So what's the temporary difference here?
3,000.
It's 3,000, sir. Deductible.
You're wrong.
Taxable.
You're also wrong. It's a permanent difference, because fines and penalties are not deductible for tax purposes. They are never deductible. So I give you also, I still revised it with you today regarding donations, and we would ensure that, and I told you that this donation, they are permanent, they result in permanent difference, because they are not deductible, and they will never be deductible. Okay, so this is a permanent difference. The one of temporary is that, okay, we are not deducting it this year, but we deduct it next year. Or maybe we have deducted it last year, so we can't deduct it this year again. Something like that. But this one, they are not deductible. So it's a permanent difference. And finally, on this question, here, I was given a carrying amount of how much? Of 8,000. And what's the tax base here? 0. Because I was told that the
The tax
repayment
base is 0, sir.
yes, because they said the repayment has no tax consequence. So, do we have temporary difference here? Here we have a permanent difference, because the repayment of the loan will have no tax consequence. So there is no need to accrue for any tax. There is no temporary difference. It's a permanent difference. It has no tax consequences. Okay, so that is that for that. Now, let's solve even more questions. I need somebody to read this for me. The guy that reads for us, Ifua. Are you in class? Okay, he's in class, but he's busy doing something else. Can somebody else read for us, please?
In the accounting year to 31st December 2017, Remi Limited made an operating profit before taxation of 55,000 naira. Income tax on the operating profit has been estimated as 22,500 naira in the previous year, which is 20x16. Income tax on 20x16 profits had been estimated as 17,000 naira, but it was subsequently agreed at 20,250. A deferred taxation liability of 8,000 naira will be made in 20x17. Required: A. Calculate the tax on profits for 2017 for presentation in the accounts. B. Calculate the amount of tax payable.
Thank you very much. Or typho. Okay, so we're told that we should calculate the tax on profits for 2017, and we should calculate the amount of tax payable. Okay, so from here, the accounting year is 2017. We're given the PBT to be 55,000. We're given the income tax estimate to be 22,500. We're not told that last year, the 2016 income tax was 17,000, but was subsequently agreed to be 20,250. We're also told the deferred tax liability will be was 8,000 in 2017. So the tax on profits and the tax payable. Okay. So the A is talking about the amount of tax that should be recognized to POL in 2017. How do we determine that? First, I need to sort out this estimate of tax that I was given. So I was given the current tax estimates in 2017. I was given as 22,500. However, I was told about some adjustment that needs to be made this year as a result of the estimate that was made last year. So we need to do adjustment for 2016 current tax. And in 2016, the estimate of current tax was how much? 17,000. But the actual tax agreed with the tax authority, was 20,250. This clearly shows that there was we underestimated in 2016. So there's an underestimation for current tax of that should be 3,250. And underestimation for tax, you need to add it in the current year. So can somebody add 22,500 to 3,250?
It's 25,750.
Okay, 25,750. 25,750. And this is the amount of tax that go to my P&L, while this would go to my statement of financial position. So in my statement of profit or loss, in fact, this is my workings one. So let me do it. My statement of profit or loss, I will have current tax expense, which is 25,750. I will also have deferred tax expense. In this case now, let me put for the year ended 31st December 2017. So what's my deferred tax expense here? I was told that the deferred tax estimate for the year was 8,000. So I will have 8,000. So the addition of the two, can you give me the addition of the two? Because that will be my income tax expense.
33,750.
Then in my statement of financial position, as at 31st December 2017, under my current liabilities, I have current tax payable. And what's my current tax payable here? I'm asking you, what's my current tax payable from these workings?
22,500.
Thank you very much. That's this, 22,500. And I'll have my non-current liabilities. Deferred tax comes in as a non-current liability, especially the deferred tax liabilities. And how much is it? That's 8,000. So as far as this question is concerned, the solution to A is this. The solution to B is this. That's the solution to A and B. Any questions? Okay. Can you please solve the next question?
Yes, sorry. Why is it not 33,750?
What's that? Which one?
Current liability. Current tax payable. Why is it not 33,750?
Oh, okay. Why is it not this? Because
Yes.
this one is deferred tax. So, which is why the other leg is coming here as deferred tax liabilities. Okay. That's the other leg for this deferred tax. But for this current tax expense, which is what we got here, this 25,750, out of it, 3,250 is already paid. We are not owing this one because it's an underestimation for current tax. It has already been paid because it's arising from tax audits. What we are owing is 22,500. I think we already explained this last week.
So
What
I
we
was
are
thinking
owing is
on the
22,500.
estimation means under now. It's not complete. Is that not what that means?
I think I just mentioned that it has already been paid now. Okay, so there is something they will settle immediately because it's relating to 2016 tax. It's not something they will carry until next year again, like this one that we're just estimating for the current year. This one is you are owing it since it's settled. It's something they will settle. The double entry is you debit bank, you credit bank, you debit this underestimation for tax. So it has been paid. We are not owing it. Okay, let's just move forward. Can you please read this second question?
For the year ended 31st July 2014, Kike Limited made taxable trading profit of 400,000 naira, on which income tax is payable at 30%. A transfer of 10,000 naira will be made to the deferred taxation account. The balance on this account was 50,000 naira before making any adjustments for items listed in this paragraph. B. The estimated tax on profits for the year ended 31st July 2013 was 40,000 naira, but tax has now been agreed at 42,000 naira and fully paid. C. Tax on profits for the year to 31st July 20x14 is payable on 1st May 20x15. D. In the year to 31st July 20x14, the company made a capital gain of 30,000 naira on the sale of some property. This gain is taxable at a rate of 30%. Required: A. Calculate the tax charge for the year to 31st July 20x14. B. I can't see B clearly. B. Calculate the tax liabilities in the statement of financial position of Norman Kike as at 31st July 20x14. Should I continue reading?
No, please. Thank you very much.
Um,
So, from this question now, we're asked to calculate the tax charge, and also we're asked to calculate the tax liabilities in the statement of financial position. You will see that before I solve any question, I would calmly look at the requirement again, especially for your level where you always have lengthy questions. Understand the requirement very, very, very well before you jump into answering anything. So I know that all the examiner wants me to do is the tax charge. When I say tax charge, it's the tax you will recognize to profit or loss. And when they say tax liabilities, is the tax that will go to your statement of financial position. Now, from the question, I was given the taxable profits for year ended 2014 to be this, and the income tax is 30%. I know that if I do 30% of this, I will get my current tax estimate for the year. I was told that there was a transfer of 10,000 that they are making to the deferred tax account. And he said the balance in this account was 50,000 before making this adjustment. So that means now that they are transferring additional 10,000 to it, then the balance becomes 60,000. You want to interpret it literally. No, well, so there's an increase. The deferred tax has increased. They didn't tell me how they arrived at it. It's good for me. So that means I don't have to bother my head about the technicalities in deriving deferred tax. They are giving it to me. All right, good. The B, they said the estimated tax on the profit in 2013. They always want to come up with this because you need to finalize and adjust for the unpaid or underestimation of taxes from the previous year or overestimation of taxes for the previous year. So in this case now, we estimated 40,000 last year, but now we have agreed to pay 42,000 and fully paid. Can you see, Madam Sarat? And fully paid. So any underestimation you will not say you are owing it because it's expected that it has been fully paid. See, we're told that the tax on profits for 2014 is payable. I mean, this question is so magnanimous because in the exam, they will not tell you all of these details. You need to know that the estimate of tax, you are not paying it this year. You are paying it next year, which is why I've told you all the details already. They also told us that during the year, there was a capital gain tax of 30,000 on the sale of some property. Oh, there was a capital gain. So this is the capital gain. And the gain is taxable at the rate of 30%. Okay. let's do this. It looks quite easy. Just like we do, the first thing we do is to sort out the current tax. So what's the estimate of current tax in 2014, which is 30% times 400,000. So what's 30% times 400,000?
It's 120,000, sir.
Thank you, Michael. 120,000. So we need to make adjustments for current tax estimates of 2013. What was the estimate of tax in 2020, in 2013?
8,000.
How much did you call it?
40,000.
40,000. What was the actual amount agreed with the tax authority?
42,000.
Is this an underestimation or overestimation for tax?
Underestimation.
That's correct. So there was an underestimation for tax. And is that much? 2,000. And don't let us forget that we had a capital gain tax of 30% times what? The capital gain was 30,000. So how much is this? That is 9,000.
So I thought it was for 2014 tax year, but we are adjusting for 2013.
Yes, now. Which one are you talking about? Is it the capital gain or which one?
The capital gain.
Yes, now. It's this 2014. This
Oh,
2014 tax. This 2014 capital gain. The 2013
okay,
issue is just the underestimation.
okay.
Yeah. So what's my current tax that goes to POL?
131,000.
1,000. Now, my deferred tax. So at the beginning, how much was my deferred tax?
50,000.
It was 50,000. There's an increase in deferred tax of how much?
10,000.
10,000.
He said it increased by 10,000. So at the end, is now how much?
60,000.
So my statement of profit or loss for the year ended, which period?
2014.
Is it 30th July or what?
31st July.
31st July. So I will have my current tax expense. How much is my current tax expense?
131,000.
Yeah, 131,000. What's my deferred tax expense? How much is my deferred tax expense?
60,000.
60,000.
I know you're going to get it wrong.
10,000.
Why is it 10,000? Why is it 10,000?
The increase is recognized in profit or loss.
Thank you very much. So you need to be very careful because this opening balance that they are bringing forward for deferred tax, they have already recognized it in P&L last year. So subsequently, it's just the increase that goes to P&L. It's just the increase or even decrease, depending. So if you go and recognize the whole of this again in P&L this year, that's absolutely incorrect. It's only the additional that can then go to, that is now a new expense. Okay, this one is not a new expense. It has happened last year. We just have to carry it forward because it hasn't been settled. So the addition of these two, what do we call it? The addition of these deferred tax and current tax, what do we call it?
Income tax charge.
Thank you very much. Income tax charge expense. And that's how much? 141,000. So in my statement of financial position, as at year ended 31st July 2014, for my current liabilities, I will have my current tax payable. How much is my current tax payable?
129.
Thank you very much. Which is just this 120,000 and this 9,000. This one has been paid. We just have to expense it this year because it was not expensed last year. So we have to expense. In fact, the double entry is the credited bank, the debited P&L. That's double entry. So what we are owing is this tax on profits and this tax on capital gain. That's our current tax payable. And that's 129,000. Under my non-current liabilities, I'll have my deferred tax payable or deferred tax liabilities. So what's my deferred tax liability?
60,000.
Correct. That's the balance of my deferred tax. The ending balance of this deferred tax. And that's the end of this question. I've gotten my tax liabilities and my tax charge to P&L. Look at the way we did it systematically and easily. Do you have any questions? Do we have any questions? Okay. No problem. So let's move forward then. So I need you to note some disclosures required for income tax that you need to put in the notes to the financial statement. The current tax expense, you need to separate it. If there is any underestimation or overestimation for tax, that is adjustment recognized in the period for current tax of prior period, which is underestimation or overestimation for tax, you need to disclose it. Also, any deferred tax expense arising from temporary difference, you need to let us know. If the deferred tax is from changes in tax rates or imposition of a new tax, okay, if that is going to happen in the future, you need to let us know. This is not common. If the tax is arising from tax losses or tax credits, you need to let us know. If it's arising from write down or reversal, if it's arising from changes in accounting policies, all that, you need to disclose all this in the books. And usually when you do your computation, we usually do like a reconciliation bit from your accounting profits to your taxable profits. We usually reconcile, or you put it in the note also, that this was my PBT. It's like the way your tax man will have computed your tax your tax expense. You need to do that reconciliation to us. Show it that okay, you need to reconcile between your tax expense and the accounting profit. If you, I mean, this is basically what the tax authority will have. The tax your tax consultant will have done all those allowable, disallowable, and all of that he did to derive that your profit. So you will not find, because this one depends on the country, so and the tax rate. So it's always difficult to ask questions around this area. And there are also other disclosures as well, which you can actually look up later. So that's that. Now let's solve more questions. Let's go. So who is reading for us? I think is another person is reading for us today. Can you please just read?
WASU PLC buys an item of equipment on 1 January 21 for 1 million naira. It was a useful life of 10 years and an estimated residual value of 100,000 naira. The equipment is depreciated on a straight line basis. For tax purposes, a tax expense can be claimed on a 20% straight line basis. Income tax rate is 30%. You are required to calculate the deferred tax charge / credits in the statement of profits or loss for the year ended 31st December 2002 and the deferred tax balance in the statement of financial position. Solution.
Okay, thank you very much, Sarat. So the question asks us that we are required to calculate the deferred tax charge or credit in the statement of profit or loss for the year ended, and also the deferred tax balance in the statement of financial position. Okay, now what's this question talking about? You say that we bought an item of equipment on January 2021 for 1 million. It has a useful life of 10 years, residual value of 100,000. Is depreciated on a straight line basis. So for tax purposes, a tax expense can be claimed on a 20% straight line basis. We're told that income tax is 30%. Income tax is 30%. Okay, so to calculate the deferred tax, what we need to do is to identify temporary difference. So when it comes to deferred taxes, the focus is temporary difference. And to get temporary difference is the difference between what we capture in our books, which is the carrying amount. And in this case, what is our carrying amount? Our carrying amount here will be the costs minus the accumulated depreciation. So the cost of these assets was 1 million. I will need to calculate my accumulated depreciation. So let's do that. I have my costs of 1 million. My accumulated depreciation is, it will be the cost minus residual value divided by useful life. This will give me my depreciation per annum. So which is 1 million minus 100,000. All the useful life. Useful life is 10 years, Abi.
Yes, sir.
So what's my depreciation per annum?
90,000.
20%, sir.
20%. Wow. What's my depreciation per annum?
90,000.
90,000.
10,000.
90,000 per annum. So to calculate my accumulated depreciation for my workings, that would be 90,000 multiplied by how many years?
10 years.
2 years.
Multiplied by 2
True,
years,
sir.
which is 2021 and 2022, because we are doing our exercise in 2022. So this gives me how much? 180,000.
180,000.
Okay. So what's my carrying amount now?
820,000.
I have 820,000. Okay. So what's my tax base? What's my tax base? That will be the cost of 1 million minus accumulated tax depreciation, which we call capital allowance in Nigeria. Okay. And they have told us that for tax purposes, is 20% on a straight line basis times 2 years. So how much are we looking at?
200,000.
100,000.
200,000. So my tax base is how much?
800,000.
800,000. Yeah. It's on now. Okay, all right.
Hello, sir.
So,
Hello. Hello, sir.
yes, Mr. Christopher.
The 20% of 1 million times 2 years is supposed to be 400,000, not 200,000.
Thank you very much. That's 400,000. So the difference is how much?
The difference is still correct.
No, it's not.
No, it's 600.
Sorry, 600.
600.
Not 600. So the difference I have, is it a taxable temporary difference or a deductible temporary difference?
Recording in progress.
Taxable.
Is a taxable temporary difference. Can you explain to us why it is taxable?
Because the value, how do you call it now? The tax-based value is lesser than the carrying amount.
That does not
Am I
explain
okay with that?
anything. That does not explain anything at all. That was not what I taught you. That looks as if you are cramming something.
I wasn't in the last class.
Oh, okay.
Hmm.
So those are in the class. Is this taxable or deductible?
It is taxable.
Why?
It is taxable because they enjoyed more deduction than the taxman. So in their own accounting, they deducted their expense was more than the tax base.
Can you come again, please? Sorry.
So their carrying amount is 820, while the tax base is 600. Meaning in their deduction, in their own accounting, they deducted more than they're supposed to deduct. That's how I understand it. So the taxman is disagreeing with the deduction.
Okay, so the taxman is only going to give them 600.
Yes.
So yeah, that's correct. Okay, so that means they are going to be getting lesser deduction than what they are capturing. So we are going to have a taxable temporary difference. And a taxable temporary difference will result into a deferred tax what?
Liability.
Liabilities, which is 30% times 220,000. So how much is that?
66,000.
How much?
66,000.
66.
Okay, 66,000. Can you tell me the double entry for this is 6,000?
Income tax.
Sir, can I try, sir?
Yeah, I'm with you. Yes, please, can try.
Okay. You credit bank. You will debit deferred tax liability.
How are you crediting bank, Michael?
Can I try?
I think
Yes,
you
please,
debit
Emmanuel.
deferred tax assets.
Okay, on my own end, since this is a deferred tax liability, we debit P&L with 66,000, then credit liability with 66,000.
Thank you very much, Emmanuel Jare. Now you're debiting deferred tax expense with 66,000, and you're crediting deferred tax liabilities with 66,000. That's the journal for this account. So this one goes to P&L as part of your income tax, while this one goes to statement of financial position. So it's the same amount that goes to P&L that goes to statement of financial position. Okay, but in the statement of financial position, it will come in as a non-current liabilities. Okay, let's ask questions.
I have a question, sir.
Okay, Manuel.
I was not in the last class, so I believe you must have talked about it extensively. It's regarding the tax base rates. That's actually on this question that says tax expenses can be claimed on 20% straight line basis. Now, is it that there's a statutory, is there a tax law that states what rate should be applied on this type of asset, or it's just something that the taxman will just decide on their own?
Yes, so it's like in Nigeria now, you know that we have capital allowance rates, right? But this is IFRS. So the examiner can just give you, they will guide you on how you calculate your capital allowance. And you will see, like I mentioned last week, for capital allowance, you will never find an IFRS question describe it as capital allowance. They will call it tax depreciation, or they will tell you for tax purposes, the depreciation is this. Okay.
Okay.
So you should know that that's a capital allowance. And,
Oh,
and for the tax man, they say it's 20%. In Nigeria, we know what the capital allowance rate are, but in the exam, follow what the examiner tells you on how they compute tax depreciation in the question. Just follow so that you can correctly compute your tax base.
okay. Thank you.
You're welcome. Can we go to the next question, please? Oh, yeah.
Wasiu PLC purchased some land on 1st January 2007 for 400,000. On December 31st, 2008, the land was revalued to 500,000. In the tax regime in which the company operates, revaluation do not affect either the tax base of the assets or taxable profits. The income tax rate is 30%. You are required to prepare the accounting entry to record the deferred tax in relation to this revaluation for the year ended 31st December 2008.
Okay. You have to be very careful with questions like this that ask for accounting entry. That means you need to pass something like this, like a journal like this. So let's look at what they are saying here. So in this question now, this examiner is telling me that I purchased a land and I purchased it for 400,000. Then I said at the end of 2008, the land is now revalued to 500,000. They said in a tax regime in which the company operates, revaluation do not affect either tax base of the asset or taxable profits. The income tax is 30%. Okay. So they want me to calculate past journal entry for deferred tax in relation to this evaluation. Let me even calculate deferred tax first. To calculate it, I will need to determine my temporary difference. So first, what's my carrying amount here? Can you tell me what my carrying amount is?
500,000.
500,000. That's absolutely correct. But that's what is in my books. What's the tax base?
I think
Oh,
it should be
I would
done.
say 400,000, but I'm not so sure.
you're correct. Because this land, there's no capital allowance on it because we don't depreciate land. So the taxman will still maintain his 400,000, which is the cost of that asset. So there's a temporary difference of 100,000. Is this temporary difference, is it taxable or deductible?
Sir,
Yes, ma'am.
sorry, but this is a land we are talking about. So should we deduct tax on it, sir? This is land.
You're not deducting tax on land though. It's just the resulting evaluation surplus. Is the evaluation surplus that is that is having a difference because we are valuing the land as 500, but the taxman is still seeing it as 400. So is the revaluation surplus that's the temporary difference here.
I think it should be taxable.
Why is it taxable? Because you are correct, but why is it taxable? Why is it taxable?
Since the current amount is greater than the tax base.
Okay. So how does that make it taxable?
I would say since it's gain on for the company, they're gaining on the land.
Thank you very much. So since we are making a surplus and the taxman will not tax it this year, he will not tax it this year. He will tell you that when you actually make that money, you will say this is an economic gain. I cannot tax it. I will tax it in the future. And when you're going to have to pay tax in the future, that's a taxable temporary difference. Alternatively, which that interpretation is not right for land because land is not depreciable and you don't get capital allowance on it, but it's still correct that we are getting lesser deduction in the future, right? Less deduction compared to what we have captured. So it's also a taxable temporary difference. But in this context, the right thing is that they revalue their assets. This 100,000 is a revaluation surplus that will be taxed in the future. That's why it's a taxable temporary difference. So taxable temporary difference will result to a deferred tax liabilities, which is, what's the tax rate? 30% times 100,000. That's 30,000. So what's the journal entry for this? What's journal entry for this? What's the journal entry or the accounting entry for this 30,000? Who can try?
Okay. We debit, if
The
possible,
deferred tax.
revaluation surplus and credit deferred tax in the SOFP.
You're correct. Emmanuel is good with double entry and is very technical. So yeah, it's actually going to go to statement of comprehensive income. Okay. And I said it's correct because it said evaluation surplus, even though it doesn't go to evaluation surplus directly. But since evaluation surplus is in OCI, so the tax impact too will go to OCI. So which is why I said is correct. So
Thank you, sir.
unlike other deferred tax that goes to POL, okay, that's for items that are in P&L. Any items that are treated in OCI, the deferred tax on them should also go to OCI. So well done, Emmanuel. So 30,000. 30,000. That's the end of this question. Any question?
Mm.
Okay, let's go to another question. Who is reading this for us?
The following is the trial balance of Almajiri Nigeria Limited as at September 30th, 2018. Deferred tax 1,160,000. Additional information: the directors of the company have estimated the provision for income tax for the year ended September 30, 2018 at 280 million naira. The required deferred tax provision at September 30 is 1.2 million naira. You are required to prepare a statement of profit or loss and statement of financial position.
Okay, the question wants us to prepare statement of profit or loss as well as statement of financial position. Okay, so from here now, I was given a trial balance and they give me deferred tax and the trial balance of 1,160,000 or 1 billion, this is like 1,160,000. So this deferred tax in the trial balance represents the opening deferred tax. Represents the opening deferred tax from last year. This is like the deferred tax at the beginning. I was now told that the company have estimated provision for income tax for the year at 2,280,000 or 2,280,000. And also the estimated deferred tax to be this. Okay, this is a very simple question. There is nothing special about this. That means in my statement of profit or loss, for the year ended September 30th, 2018, I will have current tax expense of how much? 2280. I will have deferred tax expense. In the exam, we usually would do this in the workings. We just add them together and bring them to PLL. So what's our deferred tax expense that goes to PLL?
120 million.
120 million is the increase. At the end is 1.2 billion. At the beginning is 1160. Is the increase that goes to P&L. I think we did something like that today. So what's the difference?
Forty
What's the
million, sir.
40? So what's my income tax expense? That's 2320. So you need to be very careful with deferred tax that goes to P&L. If they don't, because in this one now, they are just giving us deferred tax. Nobody's asking you to compute temporary difference and the likes. But you need to understand when it comes to deferred taxes in subsequent period, the deferred tax that go to, because deferred tax is not something you pay every year like current tax. And that's why you find it in your statement of financial position under non-current liability is payable or recoverable much later into the future, depending on when the tax authority decides to allow it. So we just put it as non-current. So in the first year, yes, the total amount goes to P&L and the other leg to liability. But in subsequent years, is the changes, increase or decrease in the deferred tax that goes to P&L, because it will just be changing. We will be carrying it forward. It's either going to increase or decrease. It's either going to increase or decrease. So you need to take note of that. So in the statement of financial position extract, as at year ended September 30th, 2017 or 2018. It's 2018, so
It's
this should be
2018, sir.
yeah, 2018. I'll have my current liabilities. I'll have my current tax payable, which is 2280. And under my non-current liabilities, I'll have my deferred tax liabilities. How much is my deferred tax liability at the end of the year?
1,200.
Yeah, that's the end of this question. I've prepared my P&L and I've prepared my statement of financial position. Any questions? Any questions? Okay. Can you please read question 4?
Wasiu plc revalued a property from a carrying amount of 2 million naira to its fair value of 2.5 million naira. During the reporting period, the property cost 2.2 million naira and its tax base is 1.8 million naira. The tax rate is 30%. You are required to explain the deferred tax implications of the above information in Wasiu plc financial statement as at the end of the reporting period.
Okay. You said you are required to explain the deferred tax implication of the above information in Wasiu plc financial statement at the end of the reporting period. So when you find out that the examiner wants you to explain, please explain. Don't just calculate. You might not get any mark. So we'll just explain to them and move on. So from here now, you will see that this guy revalued these assets from 2 million to 2.5 million. And they said the property cost 2.2 million and its tax base is 1.8 million. The tax rate is this. So you say to determine the deferred tax from the provided question, need to establish the temporary difference. From the question, we're given the tax base as 1.8 million, while the carrying amount will be the fair value with 2.5 million, because that's what will be in your books as at that date. of 2.5 million. So in this case now, the difference between the two is what would represent our temporary difference. Therefore, the temporary difference is the carrying amount of how much? 2.5 million. The tax base of 1.8 million. So what's the difference? And is this a taxable temporary difference or a deductible temporary difference? So we have a taxable temporary difference
0.7.
0.7. So the deferred tax liability is 30%, 9.7, which is how much? That's 0.21. That's 0.21. So the deferred tax liabilities will be recognized as a non-current liabilities, while the other entries will be recognized to POL and other comprehensive income. The amount that will be recognized to OCI is relating to the revaluation surplus, is relating to the tax on the revaluation surplus. As follows. So, because there was a revaluation surplus here, the carrying amount was 2 million. It was revalued to 2.5 million. So, if you do 0.3 times that 0.5, which is the 500,000, how much would that give you? That should be 0.15 million. That's 1.15 million. So from here now, we are saying that while we have deferred tax liability to SOFP of 0.21, we will have a deferred tax expense of how much? Of to POL. I also have another deferred tax expense that goes to OCI because of the fact that this deferred tax, a portion of it is as a result of revaluation surplus. So 0.15 to OCI, so the balance, that would be like 0.06. That will be recognized to, so the breakdown of the entries is as shown below. Okay, and that's how you address this. So what this question is teaching you majorly is still emphasizing the fact that when you compute deferred tax and a portion of it is arising from fair value gain or fair value surplus, you need to recognize that the deferred tax element of that should go to OCI, knowing fully well that the carrying amount of this asset was 2 million and it was revalued to 2.5 million. So that means there's a revaluation surplus of 500. 30% of that is the deferred tax and it should go to OCI. That was how I was able to determine this one that goes to OCI here, which I explained to the examiner, right? And I did all the breakdown for him. So this question, I methodically worked to my answer. I explained temporary difference, carrying amount, and tax base. I know that since I'm getting a lower deduction, I already know that, okay, that would be taxable temporary difference. And this temporary difference, when I do 30% of it, it gives me deferred tax liability. And this deferred tax liability, while one leg is going to non-current liabilities, the other entries will go to both P&L and OCI because a portion of it was revaluation surplus. And I told the examiner the deferred tax amount that goes to OCI relating to evaluation surplus. And I showed him the breakdown of the entries. Okay, so that was basically all we did. Do we have any questions?
On my end, no.
Okay.
Oh, sir.
Yeah, Christopher.
Like as it is now, we are using in a scenario whereby, can you just scroll down a little?
Yeah,
Yes, okay. The scenario whereby we have a taxable temporary difference, because we're having that because of the fact that figure that we're given from our computations or from the relevant information given, the tax base is kind of lesser than the carrying amount. What of the situation whereby we have issue of where the tax base is higher than the carrying amount? And hence, there will not be taxable temporary difference. So what do we do?
Deductible temporary.
exactly. That's a deductible temporary difference.
So in further computations, how do we allot?
It's the same way. The same way you have separated this is the same way you separated that one too. It's the same thing. Everything here is the same. The only difference is just that will now be a deferred tax assets. So
Okay.
yeah, it should be a deferred tax assets.
Deferred tax assets. Okay, that's what I
Yeah.
want to get. Well, it also maintains the same deferred tax expense and the rest for
Yes.
OCI, PLA.
Yes. But now for deferred tax assets, we don't call it deferred tax expense. It should be deferred tax income. The other leg that goes to P&L is a deferred tax income.
Income. Okay.
Yes.
All right.
Yeah. Any other questions?
Sir, sorry, is
Yeah.
this question in our material, sir?
I think so, but does it matter anymore since I will share this with you?
Okay, sir. Thank you, sir.
You're welcome. Okay. Can we read this one?
Explain the following terms in accordance with IS 12 income tax. 1. Deferred tax. 2. Permanent differences. 3. Temporary differences. B. Shakara Limited was incorporated
Wait,
on January
wait, wait,
1st, 2020.
wait. So sorry. So I want us to sort this one before we read the next one. Without dubbing, I know I can't see you, right? I know I can't see you. But without dubbing, can anybody, based on your understanding, can anyone define deferred tax? Don't open your notes, so just use your residual that you have learnt in this class to explain what deferred tax is.
Deferred tax is simply tax that is payable in the future but expensed currently.
Okay, that's a good definition. But that definition has missed a major ingredient.
Hmm.
It
You have
occurs
missed the major ingredients.
Right,
Miss
it's a
temporary
fact that
difference.
occurs as a result of temporal difference.
Thank you very much. That's the major thing that you need to mention.
True.
Temporary
True.
difference. Temporary difference. So every other thing you have said is right, but don't forget temporary difference. So there's no need to be cramming definition. You don't cram definition here, or you don't cram anything here at all. In my class, no cramming. This one, you just flex with it and give them your understanding, or give you your mark. So what about permanent difference?
I would say permanent difference occurs where an item in the financial statement has no tax consequences.
Say it again. Sorry, so sorry.
Permanent differences occur where items in the financial statements have no tax consequences. That's how I understand.
Okay. Where items in the financial statement have no tax consequences. You have not explained permanent difference. So is the difference arising? You need to express it properly. You know what you're saying, I know, but you didn't say permanent difference. You have explained something else. So maybe I explain a tax base that we won't capture or something like that. But permanent difference is the difference between the amount recognized in the books and the amount that is captured by the tax authority, where that amount captured by tax authority has no tax consequence or is an exempt item. Okay, so you have explained permanent difference fully. So you're just expressing it properly. Because it's still a difference and all of that. If I were the person that is marking your scripts, I will have given you your mark. I will have given you 1 mark because you know exactly what you're talking about. So, and most examiner hopefully would also pass you. But try as much as possible to express it in a very simple language so that they will give you your mark. Okay. What about temporary difference? Who is trying temporary difference? Am I muted?
I would
I'm not
say it's
muted.
just the difference between, no, you are not. Can you hear me?
Yes, I can hear you now.
I'll just say it's the difference between carrying amount and tax base.
Yeah, that's correct. Because this one, you didn't need to explain further that where the tax base has no tax consequence or is exempt. So this one you're okay. We're just stopping at that. So that's that for that. So Otaifu, now you can read this question, please.
Takara Limited was incorporated on January 1, 2022. During the year ended December 31st, 2022, the company made a profit before taxation of 18,150,000 naira. The following capital expenditure were made during the year: plant and machinery, 7.2 million; motor vehicles, 1.8. The depreciation charge for the year amounted to 1,650,000 naira, and capital allowance granted by Federal Inland Revenue Services (FIRS) for the same period amounted to 2,250,000 naira. Company income tax rate is 30%, and deferred tax liability brought forward was 1.2 million naira. Required: calculate the company income tax liability for the year ended 31st December 2022. B. Calculate deferred tax balance that should be disclosed in the statement of financial position of Shakara Limited as at December 31st, 2022. 3. Prepare notes showing the movement of deferred tax charged to profit or loss for the year ended December 31st, 2022. And 4. Prepare income tax expense notes that will accompany the statement of profit or loss of Shakara Limited for the year ended December 31st, 2022.
Okay, thank you. They want us to calculate liability, income tax, current income tax liability, company income tax liability, deferred tax liability, will be shown in similar financial position, the movement in deferred tax that goes to P&L, and notes. They made a mistake here because this should be, because when they see company income tax liability, it should be more of current tax, because income tax is the aggregation of deferred and current. So this was an ICAN past question, and we noted it, and this is confusing because this looks as if they want us to do current and deferred. And now they're asking deferred in the second question. So I mean, we understand what they mean, that what they really meant here is the current tax liability. So this company has a PBT of this amount, and they have these assets. The depreciation for the year is this amount. Okay. The capital allowance, okay, because this is an ICAN pass question now. I can use capital allowance granted by FIRS. So because this is a Nigerian exam, so they are free to do that. Most of the examples I've been using for you are from IS 12 directly. Okay. But now this is ICAN past questions. So you see them using Nigeria related terminologies, which is okay. So this is the capital allowance, and the company income tax rate is 30%. They said the deferred tax brought forward is these amounts. Okay. So one thing I observed in this question is if I want to do my company income tax, as asked in the first question, I'm supposed to apply It's supposed to be 30% times taxable profits. It should give me my answer, but unfortunately, I was not given taxable profits, but they gave me profit before tax. They gave me profit before tax as how much? As 18,150. So 18,150. So I need to put so to get my taxable profits, I can get that from I will need to add back disallowable expenses, which will commonly be my depreciation. And my depreciation for the year is how much? 1650. That was depreciation for the year. 1650. Then I will deduct capital allowance. What's my capital allowance? $2250. Capital allowance is 2250. And this gives me my taxable profits. So how much is my taxable profits? Can you give me my figure?
17,550.
17,550. So my current tax is 30% times 17,550. What does that give me?
$5,265.
Okay.
5,265.
Thank you. So I've done the first question. That's one. Now, the two wanted me to calculate my deferred tax balance. And to do that, I can see that they gave me some capital expenditure here. So that means I need to calculate my carrying amounts. Then compare that to my tax base. And from here, the cost of my assets, you don't have to separate it. Can you add these two together? 7,2 plus 1, 8, 10, 8, 9. That should be 9,000. 9,000. The accumulated depreciation. So they only gave me the tax charge for the year. So probably they bought the assets in that same year. So that's the 1650. So what's my carrying amount? Can you punch your calculator?
7,350.
7,350. Now my tax base is still, we'll do the cost of assets. Still the 9,000. Cumulated capital allowance. What was the capital allowance granted?
2,250.
250. So how much are we looking at?
6,750.
How much?
6,750.
37 foot.
Okay. So there's a temporary difference here. Is this a deductible temporary difference or taxable temporary difference?
Temporary.
Oh,
Taxable.
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 So I have a taxable temporary difference. And how much is it?
600.
600. Taxable difference. Taxable temporary difference will result in a deferred tax liabilities of 30% of that amount, which is how much?
180.
180. So my deferred tax balance is 180. That's the second solution. The third solution is saying you should prepare a note showing movement in deferred tax charged to POL. So movement in deferred tax charge to POL. So you just need to get the opening deferred tax they give me in the question. That the opening deferred tax brought forward is 1.2. So that'll be 1,200. Let me put my, then I've determined my closing deferred tax to be how much? 180 from what I got here. So here now, there is a decrease in deferred tax of 1020. That will go to my profit or loss. To go to my profit or loss. And that's the solution to this. Then we are asked to prepare income tax expense notes that will accompany the statement of profit or loss. So the fourth one is asking for notes to the income tax. And the income tax comprises of your current tax expense. How much is our current tax expense? 5,265. 5,265. Since we have a decrease in deferred tax, that would be like a deferred tax income. So our income tax will be the balance. So what's the difference?
4245.
4245.
45.
So at least you can see from here that the decrease in deferred tax, it came in as a deduction here when I was determining my income tax. I think it's something you should learn also. That you should. I've mentioned it, but at least we are seeing it live again. Comes in as as a deduction. Since this one is expense, this income. So and that's all for this question. Okay, if you have questions, Dami, I can see your hand.
Sir, please, sir. Please, can you explain the movement in deferred tax charge? Why do we have a decrease in deferred tax?
Okay. So since the deferred tax at the beginning was 1.2, okay, and at the end is now 180, because deferred tax is something you recompute every year. So whatever balance you get, you compare it to your opening, is it that it has increased or decreased? But for this one, it's now 180. It used to be 1.2, now 180. So it's a decrease by 1,020,000. And you see that because there's a decrease in deferred tax, it's net of a portion of the current tax expense. When we're determining the income tax, it's netted off. So that's that.
And for us to know, to able to know the decrease in the deferred tax is as a result of us trying to compute from our temporal difference, right?
Correct. For you to know the deferred tax balance for the current year, you would get the temporary difference first, and you get the deferred tax. Is this one you now compare to the opening like that? So next year again, they will compute another deferred tax and compare it with this one, because this one too will become opening next year like that. And that's how it continues. Wow.
Sorry, sir. In the other questions we're solving, when we compute this deferred tax, we're adding to the opening balance. I don't understand why this one is our closing balance instead of adding it to the opening balance.
Which question is that? We have never added deferred tax for the year to opening balance.
So like in this 1-2 now, this one that is 1-2.
Look at what going to P&L now.
Yes, the 40 difference.
Yeah, it's because this is an increase in deferred tax.
Okay.
Increase. It was 1,160 at the beginning. At the end is 1,200. So it increased. That was why we added.
Okay.
This other
Thanks.
one decreased. So we deduct.
Thank you, sir.
You're welcome. Yeah, you can ask questions. So today is just to solve questions on many questions on these deferred tax, so that you can. That's the only thing that will remain will just be, because I've not taught you group accounts, consolidated financial statements. There are deferred tax implications there too. So if I'm teaching it now, you might find it difficult to understand, because you need to adjust goodwill with those deferred tax implications. So, and I've not taught you that. So I don't want you to be cramming my solution and all of that. So, which is why I'm leaving it. And don't forget that we also left deferred tax implication of share-based payments. So before I start my next topic, I would first of all teach you that, the deferred tax implication of share-based payment, because we left it. So we need to sort that out before we go to anything else, now that we have done deferred tax. Okay, if there are no questions, can we read another question?
Babaringa Nigeria Limited acquired a factory machine for 10 million naira on January 1, 2019. The machine had estimated life and residual value of 10 years and 2 million naira respectively. It is depreciated on a straight-line basis. In lieu of depreciation, the tax authority allows a tax expense of 40% of the cost of this type of machine to be claimed against income tax in the year of purchase and 25% per annum of its tax base, subsequently on reducing balance basis. The prevailing company income tax rate is 30% required. Calculate the deferred tax charge or credit which will be recorded in Babariga Nigeria Limited statement of profit or loss and other comprehensive income for the year ended December 31, 2021, and the deferred tax balance in the please can you hello in the statement of financial position at that date. Thank you.
Thank you very much. So this question requires us to calculate the deferred tax charge or credits to P&L and OCI, and also the deferred tax balance in statement of financial position. So now, from here now, this guy, he has a factory machine. It's 10 million at the beginning of 2019. The machine had useful life and residual value of 10 years and 2 million respectively. Is depreciated on a straight line basis. We're now told that in lieu of depreciation, the tax authority allowed tax expense of 40% of costs of this type of machine to be claimed against income tax in the year of purchase and 20% per annum of its tax base subsequently on reducing balance basis. The prevailing company income tax rate is 30%. Calculate the deferred tax charge or credits, which will be recorded in Babariga Nigeria Limited, statement of profit or loss, and other comprehensive income for the year ended. Okay. So for this one now, to calculate the deferred tax here, you need to get the temporary difference. And you have to be very careful here because they bought the asset in 2019 and now we're in 2021. So first, at December 2020, at that date, the carrying amount of these assets will be the cost, which is 10 million. So let me just put something like this. And the accumulated depreciation, which in this case would be useful life 10 years, residual value 2 million. Okay. Would be costs minus residual value divided by useful life, which is 10 years. So how much would this give us?
800.
Gives us 800. That means my carrying amount is how much? 92. My tax base, the same thing, costs 10 million the capital allowance. He said initially we do how many percent? They will do 40%. We'll do 40% of costs initially, then 25% per annum, subsequently on a reducing balance basis. Okay. So we'll have 40% times 10,000. So that will give us how much? 4,000. So we are looking at 6,000. In this case, we have a taxable temporary difference of how much? 382. Now with deferred tax liabilities, which is 30% of that 382. So how much would that give us?
960.
960.
960. Now, at December 2021, how much is our carrying amount? Now,
92.
so it's still cost now minus accumulated depreciation, which should now be 800 times what? Times 2 years. Since we already established our annual depreciation from last year to be 800, so I can just multiply by 2 to get my accumulated. So we'll be having 8,400. My tax base, that will be the brought forward of 6,000. Why I'm considering brought forward here is because he said my 40% initially and 25% on reducing balance. On reducing balance. So it has to be 25%. The capital allowance now has to be 25% of the reduced balance, which is 6,000. If it were to be on straight line, I will just do it like this one. I will just do where is it? I will just do 4,000 times 2. If it was being on straight line, okay? Or if they say 25% on straight line, I will do 25% of 10,000. If it's on straight line or on costs. But since they say that subsequently capital allowance is 25% on the reduced balance. So this is now reduced balance after deducting the capital allowance from cost. So what would that give us? I have Dami's hands up. Oh, yeah, Damilola.
So, sir, from my understanding of reducing balance, I thought it's supposed to be the 10,000. That's the initial cost minus the 6,000. We have 4,000. Then we now add our 4,025 and 6%.
Now your understanding of reducing balance is not right though. So Reducing balance is calculating depreciation on the previous carrying amount. That's reducing balance. Not doing 10,000 minus 6,000 minus the carrying amount. No, please don't do that. I don't know where you have learned that from, but it's wrong. Reducing balance is apply the rates on the previous carrying amount. In this case, on the previous tax base. And since the previous tax base is 6,000, so, and that's why it should be. So how much is that?
It's 1,500, sir. 1,500.
1,500. So what's the difference?
4,500.
4,500. So we have a taxable temporary difference of how much?
2,900.
39. 3,900.
3,900. So we have a deferred tax liabilities of 30% times 3,900. What would this give us?
1170.
1170.
Yes, right.
Okay. So now we have calculated, but we have not completely answered the question. We have calculated the deferred tax balance in 2021. So this is the deferred tax balance in 2021. Who can calculate the deferred tax charge in 2021? Or credit in 2021. So that is when you look at the opening deferred tax. And what's the opening deferred tax? 960, which is the deferred tax from 2020.
22, yes.
960. What's the closing deferred tax? That's 1170. So we have an increase in deferred tax. How much is that?
210.
210. And this is what goes to your PRL. This is what goes to your PRL. So, I'll give you these as assignments. 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 So send it to me, but we're still going to solve it together. Okay, we are going to solve it together. So probably,
This one is looking.
yeah, say it now. It's looking what?
Okay, November 2019, past question. Okay.
So I would do we'll do the corrections together in class. So, but not our normal class. That will be an extra class. Because when is this class supposed to end? Is it 5 or 5:30?
5.
So I cannot start that correction. But I really want us to solve more of these questions. So if you can have extra time, maybe on a Sunday, we can solve these questions together. I'll let you know if it's something we can do, but try your hands on it. See if you can do some trial. Don't go on in to check the answer in the past question. You won't find it. So you have to ensure you solve it. Send it to me, then we'll do the corrections also in class. So I'm going to stop here for today. Do we have any questions?